Is ExxonMobil still a buy in 2025? Let's dive deeper into what's happening behind the scenes. ExxonMobil has revealed it's cutting around 2,000 jobs. As energy prices decline, the oil giant is tightening its operations. So, is ExxonMobil still the powerhouse we trust? Or is it starting to feel the pressure from the changing energy landscape? 1. Navigating a softer market. Since 2022, Exxon's earnings have decreased as oil and gas prices have dropped. But here's the good news. They haven't reported a loss in any sector. However, cash reserves are dwindling quicker than prices. This is due to Exxon's commitment to investing and rewarding shareholders, even amidst slowing cash inflows. Solid financially? Absolutely. Unaffected by market shifts? Not quite. 2. Production rising amid price declines. A silver lining is production levels. The 2024 Pioneer acquisition increased Exxon's output by over 500,000 barrels daily. This is significant and shows strong operational capability. Still, remember that increased volumes can't completely make up for lower oil prices. Production is now yielding slimmer profit margins. 3. Planning for the future. The Guyana advantage. Guyana is Exxon's key growth area. Their projects typically transition from approval to production in about 3 years, much quicker than the industry average. This leads to faster payback, quicker cash flow, and long-term expansion. By 2025, 3 out of 7 final investment decisions are still in development, expected to yield first oil over the next few years. This means billions invested in the near term as commodity prices drop. 4. Managing costs, but margins remain tight. Indeed, Exxon has reduced its production costs per barrel, but prices have plummeted even more. So operating margins are tighter despite improved efficiency. The company's proposed restructuring in high-cost regions like Europe and Canada indicates it's adapting to stay competitive. 5. Shareholder returns, benefit or gamble. Exxon keeps investing heavily into dividends and share buybacks, over $9.8 billion repurchased in the first half of 2025. This shows confidence, but it also eats into cash during tough times. Essentially, Exxon is balancing investor satisfaction while maintaining financial flexibility. 6. Strong balance sheet, the safety net. Even with these challenges, Exxon's balance sheet remains robust. Debt has held steady around $41 billion, and their leverage is low, only 13% debt to capital. This allows Exxon to keep investing when prices fall, a luxury many competitors can't afford. 7. What's next? We can anticipate more cost-cutting measures and potentially asset divestitures, but returns to shareholders are likely to stay. The aim: reduce costs, maintain flexibility, and safeguard cash flow, whilst maintaining investor confidence and share price support. Exxon isn't struggling but is evolving, adapting to lower prices while retaining its long-term strength. 8. So, is XOM still a worthwhile investment? Short-term, pressure on margins, slower cash flows, and hefty spending commitments. Long-term, disciplined management, efficient growth plans, and a strong balance sheet. This situation is less about quick gains and more about sustainability. ExxonMobil is committed to longevity in an unpredictable energy market. Closing thought. ExxonMobil isn't merely relying on past accomplishments. It's tightening up for the upcoming energy cycle. The real question is not whether it will endure, but how strong it will emerge when the next upswing arrives. If you found this video useful, consider subscribing to Decoder Insights.